All right, guys, what's going on? This is the class for the 22nd. Just going to cover the intro to EMAs in this video here. The video after is going to be intro to fair value gaps, so you guys can watch that after. But in this video, I'm going to cover EMAs or moving averages as a whole, and which ones you can use, what they are, pretty much everything EMA. And then I'll show you guys how I personally use EMAs. So before we get into how they work, we need to first understand how they, or what they are, right? So moving averages are indicators that are used to determine the average price over a given amount of days, right? So your 5 MA is going to give you a line on your chart that will show you the average price of the last 5 days, right? Your 10 MA is going to be the last 10 days, 20 MA is going to be the last 20 days, so on and so forth, right? So they can be thought of as a moving form of support and resistance, or a magnet that can be used to spot a potential reversal. Now, the way they work is it's pretty simple. Moving averages, they're calculated to identify the trend direction. All right, so if you're trading above your moving averages, you're bullish. If you're trading below them, you're bearish, right? It's a trend following, which means it's a lagging indicator, right? It's based on past prices. So your candle closes and then your moving average develops, right? So as your candle is live, your moving average has not developed yet. So that makes it a lagging indicator. All right. They're completely customizable, so you can put, you can use whichever time frame you want, you can use whichever moving average you want, you find out which works for you, and I'll get into in a little bit which ones I think you guys should use. All right, the most common time periods are 15, 20, 30, 50, 100, and 200. All right, your 200 is going to be your real large moving average. It's going to show you the average price in the past 200 days. Ideally, if you want to take a long position, ideally you want your stock to be above the 200 moving average, right? It's a higher probability setup that way. The shorter the time span is to create the average, so 5, 10, 15, the more sensitive it'll be to price changes, all right? And the longer the time span, the less sensitive it is. Now, the exponential moving average is the one that I personally use. It's the one that I teach to everybody. This is the one I like the best. Reason being is that it actually gives more weight to recent prices. All right, so it's more responsive to new information. And the reason I like that over an SMA or a regular moving average is because I day trade and I scalp, right? So I'm more worried about day-to-day price action than the price action as a whole, right? I don't want all values. I want more recent prices, right? So this is why I prefer the EMAs over SMA or moving average, all right? And there's two ways that I use these. So the first way that you can use them is for reversals, right? You can use them as an indicator that a reversal might happen. So if a stock is trading above the 20 moving average and takes a hit, gets below the 20 moving average, right? That's a good sign that your direction is changing, right? That's your change in trend. Now we're below the 20 moving average, sorry. And we are now bearish. Inversely, you can also use EMA crossovers, which this picture right here shows you a crossover. So the 50 and the 20 or the 21 are two pretty popular EMAs that are used for the crossover strategy, right? So if you cross up, like we did down here, right? That's a bullish signal. You can go long here. If we cross down, which we don't on this strategy, down here we cross down, right? This would be your bearish signal. All right, you can see every time we cross over, it makes it a really nice run. All right. The second way to use them is as magnets. I like using them as magnets. So this chart here is a 1 hour chart with the 5 and the 9 moving average. The 5 and the 9 is what I like to use. All right, and you can see that there's a couple ways to play them as magnets. You can pair them up with key levels. Even with a blank chart, you'll still be able to play this, right? So you're trading above your moving averages at this point right here. So you know you're in a bullish trend. So you want to soak any dips down to your EMAs, right? What this means is whenever price is overextended, your EMA magnet is going to pull price back towards it, right? It has to cool down. So when it pulls price back towards your EMA, when it is in the general area of your EMAs or touches an EMA or anything, you can take longs here, right? Targeting your previous highs. So you can see how every single time it comes down into your EMA area, you can take these longs pretty safely, right? And these are really, I like them a lot more so because they provide really good risk to reward ratios. So it's almost always a pretty high probability setup. So you're going to have your stop losses right below your EMA, right? So if a candle holds below or closes below your EMA, that's your stop loss. And your reward is your previous highs, right? So usually ideally it's a really good risk to reward setup, which is why I use it a lot, right? In this example, I was using it paired with key levels, so you can see how we hit a key level here, right? We get a rejection. You can also see extended. It's extended off the EMAs, so you get a pullback towards EMA long there, right? Up here, overextended, right? So you come down. And right here, that's your entry. Up here, you're overextended, come down, that's your entry. You guys get the point. So just use them as magnets whenever the price gets pulled back towards your EMAs. That's going to be your signal to enter. All right, this is another slide here showing the same thing, just zoomed in a little bit, right? So we identify a key level here. We go up, reject off of our key level, and make a move right back down to EMAs, which are sitting right here, right by the other key level. And we bounce directly off our EMAs. And then we can continue on up. All right, so which ones to use? The most common ones are for swing trading. It's going to be the 50, 100, and 200. This gives you a pretty wide range. So for swing trading, you're going to be holding things for several days. So you want to see not recent prices, but also a combination of more recent and then a little further away, like the 100 and 200. Your medium time frame, so for low frequency trading, is going to be the 20 and the 50. So that's the 21 and 50, or the 20 and 50, that the crossover comes into play. And then for smaller time frames, the ones that I personally use, the 5 and the 8 or 5 and the 9, is going to be for day trading or scalping, right? That's what we do. Now, some tips for moving average. I went over this a little bit ago, your 200 MA. If your daily chart is trading above the 200 MA, it's in an uptrend, right? You can use it as a pretty strong support. Your 50 moving average is, let's say if your price is trading below or above on an hourly time frame, shows you a short-term trend, right? And your 20 moving average is going to show you an even shorter term trend. And 5 and the 9 is going to be the shortest term trend, the shortest time frame trend. And this is more than likely what you'll be using for scalping. So that is pretty much it for our intro to EMAs. Now I'm going to just real quick, I'm going to go over our play recap for the previous day. All right, so for our play recap for Friday, it was a pretty good day that we had. we caught pretty much the entire downside move. So initially, I was bearish off the open because we had opened up right in our supply zone, right? This is our supply. We opened right inside our supply, could not break above. So already off the bat, this was a really high probability setup that we could have taken. I personally waited for a break below our EMAs here, right? And then you get this candle to retest EMAs and then the rejection. And this is all in the 15-minute. My first entry was on the break of this uptrend. We came down and we're in demand. Demand was pretty weak because, as you can see, it's been tested so many times. Been tested 1, 2, 3, and then 4 right here, 4 times, right? So this was the 5th test of your demand zone. So obviously getting weaker and weaker. So as soon as we broke below our demand, this is where I took an entry, rode it all the way down to here and sold. So that was the first play that we took. And the reason I sold down here is because we're pretty overextended from our EMAs throughout this time, right? This was we're down here, we're overextended, down here we are overextended, and down here we are super overextended, right? So we're going to make a move back up. So our second entry was on this candle here, right there, something like that. That was our entry. And the plan here was, it was just a simple short at the EMAs, right? Like the intro to EMA class that I just talked about. It was really just that simple. That was all it was. So we can see here, this is our stop loss, right here above our EMAs, and this is our reward, was our previous lows that we had. So short EMAs this entire time. We have not broken above EMAs, and sold all the way down here in this general vicinity, again because we were super overextended, right? Over here we were overextended. Over here, this is your retest of your EMA area because of the overextension. The bottom of this candle was still overextended, so this one just went super overextended, right? After you have an overextended candle and you still continue down in that general direction, you're going to, more than likely, the next candle that opens sees a move up just because of how overextended you are. This candle gets the move up, right? We sold right here because, being that they were 0 DTEs, I didn't really want to hold through the theta crush over here and the premium crush from the move up. So that was pretty much it. We didn't play the upside, called it a day after those two plays on the short side. I believe they went almost 300%, and that was the play.